Hi everyone, welcome to Jacq Chat for the second week now. I just want to make sure firstly that everyone did their homework from last week. So I sent everyone away to make sure that they put their binding nominations in place for the super and to make sure their estate planning was in order. This week we're focusing on the common individual tax deductions that are often overlooked. And I thought I'd invite Rachel along. She's our local tax expert, so she's agreed to be here today to share some of those reasons or those things with us. So.
And I'm so excited to be the first guest on Jacq Chat.
Awesome. Okay, cool. So Rachel, what are the common things that people often, leave out of the tax returns?
The first one I would bring up is income protection for individuals. So a lot of people aren't aware that they can actually claim income protection as a deduction.
Okay, so that's because sometimes income protection, some people have it in their superannuation. So can they claim that?
No, and that's a very good point. So a lot of people go, yes, I have income protection, but if it's within your superannuation fund, you can't claim it. You're actually getting a tax deduction within your super, so you can't get, double dip outside of your super as well. However, if you hold any policies that you pay out of your own pocket, you'll be able to claim the income protection portion.
Okay, so just so with personal insurances, because sometimes you can have income protection and trauma and life insurance, so is that the only one you can claim, or can you claim on some of the other ones?
No, it's just that income protection. So the life insurance and your trauma, you can't claim that, and we often suggest that clients bring their end of year statement for their income protection through, because it will clearly divide the different kinds of insurances you hold, and we're making sure that we're claiming the appropriate amount for your tax deduction.
Cool. And I think something I'll point out as well, if you're already a financial planning client of Hannon's, we'll automatically forward that information onto the tax accountants, so the tax team already have that information, so you don't have to worry about bringing that through. Cool. So that's tip number one. Tip number two.
So tip number two will be your ongoing financial advice fee. So more and more people are engaging with financial planners or are having managed funds. So the ongoing fees that you have relating to these investments are a deduction that you can claim for your tax return.
Awesome. I think some people don't realise, because some of the fees come out of their investments and they don't realise how much they're paying sometimes. So they just need to bring that statement in.
Exactly. Your statements and any invoices from your financial planner. The only thing I just want to say is to remember that your initial fees with financial planners are not a tax deduction. It is only that ongoing maintenance.
Okay, no worries. Awesome. Okay, so what's tip number three?
Tip number three is in relation to your rental properties. So a lot of people have rental properties and rental investments. What they don't understand or they don't realise is that you can claim mortgage lenders insurance on these properties. It's a borrowing cost, and it's something that we can definitely claim, and it's not something that all clients are aware of. We recently had a client that missed out on an $11,000 deduction for mortgage insurance.
Wow, okay, awesome. So so sometimes lenders' mortgage insurance can be quite a bit of money. Do they just claim in the first year? How does that work?
It gets written off over 5 years. So all your borrowing costs that you have in relation to your rental property, including mortgage fees, setups and things like that, they're all written off over 5 years. Okay. Or until, if you dispose of the property prior to that, then it will be taken up then.
Okay, so for that client, it would have been 11,000 divided by 5, and they claim that.
Exactly. So it's quite a significant amount that you could be missing out on.
Awesome. Okay, cool. And I think there's maybe one more tip that you have.
So the last one is to do with allowances. So most people are aware of, the general things that they can claim for their returns, such as motor vehicles and tools and uniforms, but not everyone's aware that they of their allowances they're receiving as an employee. And I would definitely suggest that they know what they're being paid in regards to allowances such as travel, overtime meal allowances, because there's definitely deductions that can be taken up associated with that.
Okay, so I think overtime meal allowances, like if someone has them, do they have to keep all the receipts for those, or how does that work?
So the way it works is the ATO sets out a reasonable rate that we can claim up to without receipts. So while you don't need receipts, if you're going to go over that rate, absolutely keep them, because it's going to increase the deduction that's available to you.
Okay, awesome. And actually that kind of leads me on to our Jacq Chat for next week. So what we're going to be focusing on is delivering and letting you know what the areas that the ATO are focusing on. They've already released some information to say that they're targeting particular deductible areas, I guess. So we're going to talk about that next week. So thank you so much, Rachel, for joining us today, and looking forward to next week.
Me too. Thank you.
Cool.